Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to the In Conversation With series, a series where I speak to notable figures in the realm of financial services. Listen as they share their personal journeys, thoughts on the industry, and advice for aspiring advisors. I'm Kimberley Dondo, Digital Content Manager, and today I'm joined by Nick Clay, Portfolio Manager of the Redwheel Income Strategy at Redwheel. So, Nick, if you could give us a bit of a background about yourself and how you got started in financial services.
Yeah, certainly. And thank you for having me. So I'm quite old. I started in 1991 as an analyst for Sun Alliance back in those days. And over the course of my career, I moved into portfolio management and focused for the first part of my career up to 2000 on UK equities. Running money at Morley, as it was called back those days, but basically in Viva's investment arm. And then when decided to call it a day there and move on, that's when I moved to global and moved to Newton. And did a bit of global multi-asset and global equities at the same time. And then sort of found my calling, which was in global equity income, which I joined the team at Newton in 2012 and have been doing that ever since. And then the whole of the team of Newton left Newton in March 2020, and we resumed what we were doing at Redwheel, or RWC as it was called back then. At the end of 2020, and have now been continuing running that strategy ever since.
Great. Well, it sounds like you are probably well placed to answer quite a lot of questions, having faced different times of volatile markets. So I wanted to touch on that a bit more. Recently 2 banks have collapsed in the US. And I just wanted to know what you would say is the best strategy for investing in a volatile market.
Well, you're not going to be surprised to hear that I'm going to say it's an income strategy that's best in the volatile market. I think what's interesting and what's become interesting, obviously very lately with the collapse of Silicon Valley Bank and Signature Bank, is that we have been in an investment environment, particularly since 2008. Some would argue even before that, but particularly since the financial crisis in 2008, where we've had a backdrop of QE, quantitative easing, pumping lots of liquidity into markets, and a zero interest rate environment or very low interest rate environment over that period. And that has created a lot of problems. It's created a problem that it went on for so long that most investors think it's the normal investment environment. And the environment it created was one basically where markets just went up and there wasn't a lot of volatility. And it kind of pushes people to think that the way you grow wealth over time is quickly. You buy crypto on a Friday and you're a millionaire by Monday. It's quite easy. How difficult can this be? And you get lured into this false sense of security that risk isn't really something you need to worry about. And the volatility certainly isn't anything you need to worry about. And it's all about making more money on the way up. The problem with that is that is highly abnormal as an investment backdrop over any other time period through history. A normal environment is one of volatility, is one of economic cycles, is one of inflation, etc. And that creates volatility across asset classes. And that is just a normal investment environment. And that is what we are now moving back to because inflation's come back. We are having to exit QE. We're having to raise interest rates again and return to normal. It just feels very different for everybody because most people are not used to it. And when you go back into times of volatility, suddenly risk becomes really important. And, no more so than in banks. And I think what's really interesting in banks is that there's this massive narrative around the market these days of that banks are far safer than they've ever been, because they're far less levered businesses operationally geared, financially geared businesses than they were going into the financial crisis in 2008. So they must be much safer now, mustn't they? Which slightly misses the whole point, which is that banks are levered businesses, full stop. That is how they make their money. The fact that they're less levered than they were in 2008 doesn't make them actually any less risky. You look back at all recessions through history and banks go bust. In 1980, in the recession in 1980, about 275 banks in the US went bust, and they were less levered then than they are now. And so, suddenly you get this rude awakening returning to markets, which is what sparks panic in the short term with markets, because it's such an unfamiliar situation for people. That risk has always been there. It remains very much appropriate. And it's something that therefore has to be thought again when you think about volatility in equity markets. And that changes your attitude to how you're going to grow wealth. So you go from growing wealth quickly, getting rich quick, to growing wealth slowly. And when you grow wealth slowly, the key thing you want to harness is the compounding of something, the compounding of growing wealth over time, and a focus upon a resilient and durable dividend or income in a strategy, and the ability to compound that becomes a very powerful tool in a volatile backdrop, because it tends to, if you pick the right companies and they can continue paying you dividends through difficult times, then the compounding of that dividend helps you suffer with volatility. And mathematically, because negative numbers are more important in a volatile time series, it helps you navigate those volatile periods. And so we think it's a highly appropriate way of trying to grow people's wealth in a more volatile environment, which is what we're now returning to, which just happens to be a normal investment environment. It just feels very different because we've got so used to the abnormal period.
Yeah. I think a lot of people got used to the instant gratification of it all. And now we have to kind of move back to a delayed gratification, which ultimately I think feels better in the long run. But
you've had a lot of people have become conditioned not to think like that. Yeah. So to exit that Pavlovian response, and then the world in which we operate, with social media and everything is instantaneous.
Yes.
It's going to take a while. This is not something where people are going to just change their attitudes and change their behavior overnight. It will take a good number of years to retrain or recalibrate people's the way people have to think about things. But it is going to have to happen unless inflation suddenly disappears as quickly as it arrived, which seems unlikely. I would argue it's a low probability event. Then we are stuck in this volatile environment for a while, and therefore we are going to have to retrain ourselves.
Yeah. So what makes GI the most attractive in this environment?
So I would argue that what differentiates this strategy is the disciplines. So, we have a strict buy discipline and a strict sell discipline. And those two disciplines mean that bar us being complete idiots and picking 42 companies which are all going to cut their dividends, we are pretty much guaranteed that we're going to generate an income yield on our portfolio greater than that of the market. But those disciplines also mean that we're focused upon durable quality businesses. Those disciplines stop us doing what lots of other income funds do these days, which is called barbelling, where you go and buy something that doesn't yield very much at one end of your portfolio because it's really fun and sexy and exciting and grows a lot. And then because of that, you have to buy something that yields quite a lot at the other end of your portfolio. So you barbell your portfolio in order to generate a yield high enough on your portfolio to call it an income fund. And what that's worked very well over this abnormal period of QE and zero interest rates. But what that has done is it shifted the investment thesis of lots of income funds over time to have much lower yields and yields which are barely above the market. So they're not compounding a bigger number, which isn't therefore statistically to the advantage. And also to have forgotten about valuation as a key discipline. So having that discipline imposed upon us, we think is really key, because it stopped us going down that investment thesis creep. And it has meant that therefore now is highly appropriate again. You want to be able to find quality companies at what we call at a reasonable yield or a decent valuation, and that you can compound a higher yield than that of the market in order to generate that total return. But you need the disciplines to do it. And you particularly need the disciplines to do it in volatile conditions, because in volatile conditions, you need to be forced as a human being to set out of the things that have done very well, and to buy into things when they're under a bit of pressure. And there's some kind of controversy surrounding those stocks, which is very difficult to do as a human being. When things are going wrong and you try and buy something, most of the market's telling you you're an idiot for buying it. Can't you see something's going wrong? What fool would go there? And equally, when you're selling things which are doing really well, you're told you're an idiot too, because now the market's in love with those companies, and which fool would be selling such an amazing company? But when valuations matter and volatility is the backdrop within which we're having to operate, being encouraged to try and do the right thing at the right time is a strong discipline to have imposed upon you, because as a human being it's difficult to do that, and we're no better or stronger than any other human being. So we need those disciplines to do that, and I think that's what sets up this strategy to be able to cope and be highly appropriate in this environment that we face.
Right. So which sectors are the best for dividend payouts? Those with the ability to suffer, and why?
So, there are traditional sectors which generally tend to be pretty good, like staples companies, your Pepsis, etc. But you have to, again, be careful about valuation. And some of those staple companies we think are getting quite expensive. What's interesting is you can look across most sectors and find very good business models which are durable, able to suffer economic cycles and downturns and carry on paying out decent dividends. And the areas that we think at the moment which offer the best value for those characteristics are in luxury retail. So things like Richemont, things like which is Cartier jewelry predominantly, things like Kering, which is Gucci and Yves Saint Laurent and Bottega Veneta, and things like Tapestry, which is Coach and Kate Spade handbags, basically. And these luxury goods companies, we think, are far more resilient and stable than the market believes them to be. The market thinks they're quite cyclical at the moment. I think they obviously think that it was that everyone in China was the only people that bought their products, and of course China was in lockdown, and so that was a disaster. But it was only ever going to be temporary. And I think right at the moment, they're being volatile in this environment we're seeing with the banks troubles that we're seeing. That everybody thinks, well, if Silicon Valley's banks are going bust, then people in Silicon Valley are going to go bust, and it's only the rich people in Silicon Valley that buy luxury goods. Some mad, strange sense of logic that will be applied. And yet we think these businesses are incredibly stable. They have incredible pricing power by definition. They sell it's expensive. It's not about the price. And quite frankly, 15 years of QE has made the top part of society ridiculously rich, and made it very in a massive amount of inequality across society. And that is their customer base. And so they are in a very strong position to weather any kind of economic slowdown. And yet they're being priced at, valued at, on free cash flow yields and on some dividend yields, as if some of these brands are going to go bust in about 6 to 8 years, which we think is utterly nonsense. And so your risk reward in terms of your likely range of outcomes for these companies, we think is skewed in your favor. And we think a very similar dynamic is at play in the semiconductors industry today. Everybody hates semiconductors, whether it be because they're cyclical, and of course we're going into slowdown, and or they are the target of the US-China tensions which are going on in the US trying to ban China's access to high-end technology. And yet again, as an industry in semiconductors, we've been through these big waves of cyclical, volatile times, and yet throughout that, the industry has become more and more consolidated, and therefore more and more capital intense, and therefore more and more discipline on some of the pricing. So TSMC, for example, now has 87% market share of the high-end chips. Qualcomm completely dominates as a monopoly pretty much in 5G. Samsung in memory, etc. And we think that dominance means these companies are better able to suffer cycles, which their industry does go through cycles, but better able to suffer those cycles. And yet again, the valuations that these stocks have been put on as if they're going to plunge into the biggest recession they've ever been in their lives. And we just think they're not put up for that. So again, we think that those companies, the luxury goods and the semis, offer by far the better risk reward for what are good, stable companies which have got a history of being able to sustain dividends through time.
Okay. So earlier we touched a little bit on how inflation had a very small chance of, going away, and that you view that it will be more persistent. Is there any way that you think, or how could the recession be beneficial for us in the long term?
So I certainly think this isn't a pleasant viewpoint to hold, but I certainly think that a proper, quite deep recession is what we need.
Is that because of the delayed gratification thing that we were talking about earlier, slightly to reteach us those lessons?
Exactly right. I mean, it's that the economic system with which we work to in the Western world is capitalism.
Yes.
And capitalism requires cycles. It needs cycles to clean out the misallocation of capital, the weak parts of industries, etc., in order to remain more secure as a system each time we move forward. When you stop those cycles from happening, you stop that process from happening. And what you then create is this environment where we're carrying lots of misallocation of capital, lots of weak companies, and you just keep building up the fragility of the system. And of course, constant rounds of QE, stopping cycles from happening, stopping things from going bust. The pandemic was another great example of that. It's just built up a system that becomes incredibly fragile and incredibly addicted to constant bails out and constant savior from our central banks. And then when you suddenly inflation returns, which hasn't been around for donkey's years, but inflation finally returns, forcing the hand of your central bankers to suddenly start to reverse all of this and take away the drugs of QE and zero interest rates. Well, go figure, the market starts to have a really hard time trying to cope with this, and they get very upset that they're having their drugs taken away and we'd quite like them back, please. And everything seems to be about, can we just get them back? Can we have a pivot, please? Can we do, everything is about when are we going back to the good old days? And yet inflation, I think, dictates that we can't do that. And unless we have a proper recession to clear out some of the excess capacity and make the thing more stable, the chances are that we're just going to end up with inflation around for far longer, because we need the recession to bring about the demise of inflation. And so the market's desperate for the Federal Reserve to pivot and they're jumping on these bank failures, etc., as a really good, excuse now that we can call an end to interest rate hiking. And if anything, we even start cutting again by the end of the year. Wouldn't that be brilliant? Well, no, because it means that inflation is probably going to be here for longer and it's going to stay around for longer. And history teaches you that although brutal, recessions ultimately are good things for the longer term, whereas a prolonged period of inflation is actually a very difficult environment for people to invest in, because your real wealth just gets eaten away. Now, the problem is, I want a deep recession to happen. However, I would argue the most probable outcome is not going to be that at all. I think the most probable outcome is that the Fed will blink and that they will pivot. And I think that governments particularly have a vested interest in making sure that central bankers pivot. Governments have all this debt, record levels of debt, the most debt they've had since World War II. The only way you get rid of that debt is through inflation. That is your sneaky way of defaulting on your debt through time. So they have a vested interest, governments, to want inflation to remain higher for longer. And the person who can least able suffer interest rates going up are governments. It becomes very expensive to service their debt. So they have no real incentive to see interest rates go up too high and bring inflation under control. They quite like the other thing, interest rates not to go up too much and inflation to be around for longer. And that, if that ends up being the most likely outcome, which at the moment I would argue the probability of things points to that being the most likely outcome, and the bank crisis we've just been through just further makes that more likely, then you're going to have a backdrop where inflation is around for longer. And of course, again, going back to what we were talking about earlier, what history teaches you is when you're in periods of inflation coming in waves through time, you are going to get very volatile backdrops in all asset classes. And again, you have to think differently about how you invest, and trying to protect your real wealth is something that's going to be is the biggest challenge. And again, that's why, going back in history, companies' ability to grow dividends over time, because they can put their prices up, they can grow their cash flows and grow their dividends, gives you some kind of protection to be able to keep up with inflation. And the distribution in sterling on this strategy last year grew by 10%. So it's a way of trying to keep up with what's going on out there. And lots of other asset classes will struggle to be able to deliver that, particularly bonds, which everyone gets very excited about when yields get up to 4%. But if inflation is going to be more persistent and hang around at a level that's up there or higher than that, then they're not the best investment to be making at the moment.
Yeah. Well, you've given me a lot to think about and reframe my mentality and think more in the long term and think more cyclical, like you've been saying. And I hope that our listeners also feel the same way. But thank you so much for speaking with me today, Nick.
Thank you for having me.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.